Hi guys, welcome back to another video on the NZDayTrading101 channel. I'm Shami, and today I'm just going to talk to you guys about ignoring people's opinions. So let people say whatever they want. People are going to tell you invest in this stock, invest in that stocks, but at the end of the day, never listen to what anyone says. It's all about what you perceive in what a good stock looks like. So for me, I don't take anyone's opinions. If someone says, "Oh, Air New Zealand is a good stock, you should invest in that," or Plecture or PLX is a good stock, you invest in that, or CBD is a good stock, marijuana is going to be legal in the future. If anyone ever tells you that, just fully ignore them, because at the end of the day, what trading is, it's 90% emotion. So with emotions is a huge thing, because if you can't learn to control your emotions and you're going after people's opinions, you won't be a good trader. And in order to trade stocks short term, you need to know for yourself what is a good stock to trade and why you're in the stock, good place to get out, and your target price. And you can trade anything. The company doesn't even have to be the best company. All you need to know is, does it have volume behind it, and is the price trending higher? So today I'm just going to talk to you about an example. Let's say so I've got Kathmandu up on the screen here. So let's look at Kathmandu. So as you can see here, so Kathmandu basically went up, flat top breakdown over here. So let's get my tool out. Cool. Had a flat top breakout here, then it started to just go higher. So when it came up to this, as you can see, this is the Bollinger Band over here. So for me, when a price is outside this Bollinger Band, I know that it's got huge upwards momentum, so it's going to be really high. But at the same time, I know that because it's outside the Bollinger Band, that it is going to pull back, and it's going to pull back hard. So I've got to be very careful whenever the price is trading outside this Bollinger Band. So as you can see here, previously, over here, the price is outside the Bollinger Band, continued to move higher, topped out here, then started to go back down. So and then the price has moved back into the Bollinger Band, and it started to consolidate sideways again, and then went for its next leg up. So here we saw a huge top in action. This was way too far from the, this is really outside the Bollinger Band here. It was very far away from the 9 EMA as well. Look at the distance between the 9 EMA and where it's topped out there. So when trading this, you've got to be really careful. And one thing else I'm going to tell you guys is that these levels here, this $1.50, these dollar levels, even $2 up here. So it's got to be these dollar levels, like $1, $1.50, $2, $2.50, $3, all these 50-cent levels, these are very important psychological levels. So psychological levels means they're kind of like whole numbers. No one really talks about a stock that's at $1.23 or $1.32, So people talk about stocks that, oh, it's at $2 now, it's at $3 now, it's at $2.50 now. So for me personally, I feel like stocks actually behave in a certain way, that they trade around these sort of levels. So these are pretty good. It's a good way to kind of decipher psychological support levels, just places that people think it's $1.50 now, it's too high, I think it's going to go down. So these are actually really important levels to me personally. I mean, it might not be to you, but so that's all good. Yeah, so don't get carried away in news. If you see that a company is really good, personally I wouldn't invest in it, because even the best companies fall, even when stuff like this crisis happened. What did you see? You see stocks just go bang, and they're down 30%. It can be the best company. You saw main freight fall, stuff like that. Those companies from New Zealand, like blue chip stocks. So you just gotta be careful. If you know that a company is pretty solid, you don't have to invest in it, just trade in it. Or if you are going to invest in it long term, then you can also trade around your long term investments. That's a pretty good thing to do. But yeah, so you just gotta watch out. Me personally, I don't really invest in stocks. I trade them. If something's going up, I'm in it, and as soon as they stop going up, then I'm out. So that's me personally. So yeah, so what I tend to do is I'll just take away these lines here. Remove any drawings. Yeah, so what I tend to do is I like to get in places like, you know, the flat top breakout happened here. So you saw the flat top breakout here, so I'm in it. You know, it's breaking out. I'm in the stock. I'm going for a gain. Let's see where it'll top out. Made my 24%. You know, people don't even make that in like 1 year. You know, people are like going for like 8% returns per year. I'm making like, oh, well, people can make like a, you know, 20% returns in a few days. So, and then you just got to watch for that topping action. You know that it's outside the Bollinger Band here. It's basically overbought. So overbought and has strong momentum to the upside. And you know when something is going up really fast, it's going to fall really hard. So, but this is just Kathmandu stock. A lot of stocks are having this huge momentum upwards. So you saw stocks like Air New Zealand. So the two best stocks to trade in the market right now is, whoops. The two best stocks to trade in the market right now and in general are probably Air New Zealand and Kathmandu. And the reason for that is simply because, whoops. So the reason for that is simply because Kathmandu and Air New Zealand have really good liquidity. They have a really tight spread of 1 cent, meaning, so the spread is quite important. So if a stock is trading at $1.23, so and then the buy price is $1.23 and the sell price is $1.24, that means there's a 1 cent spread and there's good liquidity on the depth as well. So you can get in and out real quick. Like you don't want to be trading stocks that are real slim. So there's stocks that like, you know, like $3 and, you know, like something like Serco at the moment is not that liquid because you see like a 5-6 cent spread. So you see it like the buy price is like $3.20 and the sell price is like $3.30. That's a 10 cent spread. So those are very risky stocks. So you want to make sure that the stocks you trade only have a 1 cent spread because, or maybe even up to 2 cents. Like it can be 5 cents, but like you just gotta, obviously in time and with the more experience you guys have, you kind of know. But the safer stocks you want to trade is something with a 1 cent spread. So Air New Zealand, Kathmandu, very good liquidity, very good spread, and with good spread comes like a really good price action. So as you can see from this chart here, you can see that you know, it's forming nice patterns. So these are technical analysis patterns. So yeah, you can see the volume down below. You can see like it's just in New Zealand. So you can see kind of it's going up, consolidate to the side, and it's just running up, and now it's coming back down. So then what will happen is probably start to form another pattern. I don't know how low it will go. Probably go low like that, then probably jump up, then probably do a flat top breakout, and then start to go back up again. So you just don't know. So so these things, like how we make money in a market like this, we've got to remember that this type of market is a very volatile way to make money. You just got to take advantage of these short-term moves, and you can do that. It's just all about risk management. You got to be very careful. Trade in something that's going upwards, not downwards. So like this here, I probably wouldn't trade Air New Zealand because it's currently trending downwards. So I would probably wait for it to hold, and when it starts to consolidate to form a range and it's starting to go to the upside, then I'll probably start trading it on the way up. So there's no, well, if you've got lots and lots of money, then you can probably just keep, you know, buying on the way down, on the way down, so on the way down. So that's called the martingale strategy, but obviously not lend a lot of money for that. And the thing is with stocks as well, like you can't shove too much money behind stocks as well, because if you're shoving like, you know, 100 grand, 200 grand, 300 grand, you know, into stocks in and out, there you have a liquidity problem, whereas you won't be able to get out of the stock because you're simply just holding too much stock, and there's simply not enough buyers at that sort of if you're selling like 100 grand worth of stock, there's not enough buyers for you to sell to, so you have to sell at a much lower price. So you've got to control how much you're actually putting in and out. So that's why I don't want to put too much. Like just depends on liquidity too. Like something like Air New Zealand and Kathmandu may yeah, I don't know. You just got to see on the, you got to look at your market depth and see like do you have a support there more than 200,000-300,000, you know, then you can, you know, chuck 50k and you can kind of chuck it out because you know that you have 50k worth of sellers there. So you just got to chart, like, time it as well. And for all these people with like $1,000 accounts or sharesies, like, the perfect thing to trade, because you can easily get in and out of stocks. The fees are quite low, and if you've got a $1,000 account, you can easily make like, you know, $50 to $100 per trade. So there's a learning process to it. And for you guys that listen to this video, also People that are not on my Instagram, check out my Instagram. I give a lot of tips on there. I do stories now and again when I find time. Just giving out random tips on what I think and screenshots of what other really good posts are from other people out there in the world. So yeah. So that's all for today, guys. So yeah. So basically, this video is just a little bit about, like, do not listen to what other people say. Like, you know, people up here that are investing in stocks, like, they would have invested here, and they'll be like, oh, buy Air New Zealand is going up. Next minute it's down. And you go back to the same person and be like, oh, Air New Zealand's down, and they're probably like, oh, I don't know, like, you know. Don't listen to what other people say. Make your own judgment calls. Use technical analysis. If you're an investor, then this video is probably not for you, because investors kind of just shove money in stocks for long term, and then the company grows and all that. But I'm talking to our short-term traders that are on this channel. Like, take advantage of these short-term moves. Like, it's quite easy. Like, it will click. It takes time, but it will click. So you just got to hang in there. So what you want to be doing is getting in here. Whoops, getting in there, and then, you know, you want to ride out. Make your 25% gain, and then you'll get out, and then you'll probably just get in again when it's starting to go up like that. So you want to be making these gains up here. So it's simply, the strategy is just like buy low, sell high, buy low, sell high, buy low, sell high. So if you keep doing that, you can accumulate a lot of profit. So yeah, that's something I would suggest if you're a trader. Like, and for a lot of people out there, like, we don't, even myself included, we don't find time to day trade. Like, you know, we're working in jobs, we have businesses and stuff like that, and we simply don't find the time to day trade. So swing trading is a great thing to do. So just remember that if you are swing trading, make sure that that the stock is trading in a tight range. So because if a stock is in a tight range, then that means we can kind of manage our risk a lot better. I mean, the thing is, if you get in, you know, something that's kind of trending up here, so like this, right? If you invest in here, how are you managing your risk? Like, if you invest up here, like, you can manage your risk if you can cut your losses right there, because you expect to double it. So if you're getting at 193 and you're willing to cut your losses at 182 kind of thing. But that's the really another thing, is important to use a stop loss. You've got to know where to get out, because if you don't know where to get out, then you're going to get burned. And if you get burned, then emotionally you're not going to be, you know, in the game. You're not going to be ready to learn. And that's the thing. Don't get burned. Take your gains where you can. Cut your losses quick. Have a plan for each trade, and don't be trading willy-nilly. Another thing is, don't become an investor. So a lot of people, what happens is they try trade something, then they're just down, and they'll just hold it for ages. So there's certain times when you can do that, and there's certain stocks you can do that with, but there's also times where you can't, and there's also a limit that you've got to put on it. So it helps you stay in the game long term and accumulate profits over time. So it's definitely a learning journey, but something that definitely anyone can do. So yeah. So that's all for the video today. So thank you for watching the video. Like this video, subscribe to the channel. Appreciate for the subscribers and stuff. You know, I feel good about teaching people, and my Instagram account is @SoloDayTrader. So just type in Solo Day Trader, you'll find like a little, there's like a bunch of computer screens on the profile pic. And then you hit me up on my Instagram, like through messages. I'll try and answer a lot of questions as much as I can. And yeah, until then, safe trading, guys.